With that, a company has prepared the following fixed budget for the coming year. So sales, 20,000, production, 10,000 units, production 10,000 units. And we have the direct material cost based on the budget. It says, budgeted selling price is $10 per unit. $10 per unit. At the end of the year, the following costs had been incurred for the actual production of how many? 12,000 units. So the actual unit is 12,000. Incurring these costs. Required. I. Prepare a flex budget for the actual activity. Okay, simple. So AI. Flex budget. So in a simple language, we're going to make it simple for the examiner as well. So in a simple language, the first thing we're going to be bringing is our what? Sales. So if we bring the sales, what is the actual selling price? What is the actual selling price? We have to divide, right? So divide. What do we have? Yes. So I could go this way. 122,000 divided by 12. So 122 divided by 12 times the actual unit of what? 12,000 units. This is what I was telling you about. Say, do it on the face so that you are not doing this calculation separately somewhere. But you're 132. 320. We are working in 3 zeros up. Yes. Okay. Next item, direct material cost. What about that? We are going to go through the budget and say 50,000, which is the budget, divided by the budget of 10,000 units, times what? The actual unit of. What you say? You didn't get that.
You want the per unit, then you multiply it by the output.
The 12,000. What did you get?
1,220.
Hey.
It
should be. Where do you go? Rainbow.
Is that not 100 and?
This divided by this times this.
What is the 122?
The 122 is the cost.
The total cost.
The total cost.
So you have the zeros. I got 10.17
times 12,000.
But you get 12204.
And that's what you got. Hey, you're ready. And that's saying me confusion and saying me can't put. Maybe I'm a job.
122,000. 122,000. Yes. 122,000. Divided by 12,000.
So 122,000. 122,000.
We are talking about the missing side.
122 divided by 12.
Is it 12? It's 12,000.
Relax. I'm coming. What is the budgeted selling price?
The budgeted.
For the selling price, we don't need to divide with this. Sorry. Get it well. The budgeted selling price has been given as $10 per unit. So all we do is to bring that $10 and multiply it by the actual units. So that will give us how much? 120,000. Now I'm working in 3 zeros up. Is that good? So I write 120. Now when it comes to the direct material cost, follow me carefully. The direct material cost budget is 50,000. The budgeted unit is how many? 10,000. Into when we divide, we will get the budgeted cost per unit. Then we multiply it by the actual unit. So what do I have? So 60. Next one, direct labor. What is the budgeted labor cost? is the budgeted labor cost?
25,000.
25,000 divided by the budgeted units. Still 10,000 times 12,000. What do we have?
25,000.
Hey.
Yeah. 30,000.
You get what?
30,000.
So 30. Variable overheads. Now maybe, I don't know if we can do professional presentation. 60, 30. So that this will be prime cost 90. Okay? Prime cost. Then we bring variable overheads. How much? What do we do? Variable overheads.
15,000.
How? How did you get that? 12,500 divided by 10,000.
I was just giving the figure.
You punch already?
No.
No, variable overheads is not 15,000. The 15,000 is the actual. We are doing flex budget to operate on.
12,500.
Yeah, divided by 10,000 times 12. What do I have?
15,000.
So 15. Now you see, in this question, the examiner said we should prepare a flex budget. So we don't know if we can go by the marginal costing principle and try to represent it in that order. But we could go by that, so that when we take out those from the selling price, we'll get what? The contribution. What do I have? Hey, fixed cost. You know, fixed cost doesn't change, right? So fixed cost remain the same. If the fixed cost on one divide it, you divide it, right? You don't divide. So with the fixed overheads, what is the budgeted? 97,500. So and one I remember 97.5. Now I don't need the final answer. So that's the flex budget. Do you understand? So simple, sweet, straight to the point. So doing this working separately somewhere, wasting the time to write it and coming to multiply it here is tedious.
You have come again, the fixed cost.
Yeah. Fixed cost remains the same irrespective of the output level. So for the fixed cost, the one in the original budget will be the same thing in the flex budget. We don't flex it.
But there was one question we did in class. We divided.
Really? We are not supposed to do that.
Flex budget.
We are not supposed to do that. We are not supposed to do that.
So you take.
So you take the budget figure and bring it here. Makes sense?
So the budget figure was 10,000.
No, the budget figure. Oh, it was 10,000. I'm really 95, Baba, sorry. So 10. Indeed, if we want budgeted profit will be what? 5. There you go. So that's the flex budget. That's the flex budget. So that's one thing you must note. With fixed cost, it remains the same. So whether we produce 10,000 or 12,000, it will be the same. So we won't divide. So that is the I. Then the I, the examiner said we should do what? We should calculate the variance. So we put flex here, budget here. We will put actual results here. Then we will put the variance here. So let's go with the items. 1, sales. So let's go. Sales. What is our flex sales? 120. What was the actual sales? Feed me with figures, please. Actual sales.
Actual sales was 122,000.
Variance. Variance behind. Good or bad?
Bad.
A liar has a tail. It has a big head and a very small. This is revenue, right? So when your actual is more than your budget, It's a favorable variance.
I need to record, otherwise this is
No, I'm recording everything. They know that the teacher like dancing. Direct material cost. What do we have? Flex 60. What's the actual cost for material cost?
So also 60.
So there is no variance there. We go. Labor cost. What we got? 30 for the flex. Actual 15. Are you sure? I can see 28.
Labor cost 28,500.
So 28.5. What do we have?
1.5.
1.5. Good or bad? Good. Because we've incurred less cost than we are supposed to what? Incur. Next item, variable overhead. Flex is what? 15. Actual.
15.
Also 15. So no variance. Then the next one, fixed overhead. Flex is still what? 10. But the actual is, so that's a favorable of, adverse of 1. Adverse. So there you go. There you go. We're done. We're done. Into a way 9 out of 10 marks. Even the examiner said we should use marginal costing approach. So please, let's do that here. What's a use marginal costing approach? So we have to do the same thing in the variance. So no, I'm not cleaning everything. So give me variance. Give me contribution here. Because he said we should use marginal costing approach.
So if you are using the other
Absorption costing, then everything will just come like that. But your mama may answer. 15, and then this one. What is the actual? Okay, it's already there. It's already calculated. 114.5. It's already in the question. Can you see that one? Can you see it? Oh,
Contribution is 18.5.
sorry. That's total cost. 18.5. Okay. So we go. Less the fixed cost now. Let's get a profit. 5 here. 7.5 there. So that's it. So this is the variance using marginal costing principle. So that's the A aspect of that question. Ryder Co. is evaluating its investment project as follows. This is an investment in new machinery to produce a recently developed product. The cost of the machinery, which is payable immediately, is 1.5 million. Okay, so let's put some preambles up. 1.5, or we can say 1,500. And the scrap value at the end of the 4th year is expected to be about 100,000. So that will be 100. So we have the cost, we have the scrap value. Good. Now the life of the project. So the life is also 4 years. Of the bet we know it's 4 years. Capital allowance on the flip side can be claimed on this investment by what? So CA is 25% reducing balance. But remember I told you that if the examiner says capital allowance like this, it is actually what? I said if the examiner says capital allowance like this, it is actually what? The depreciation figure. Because capital allowance, we have to always use what? The tax rate. Okay. Information on future returns from the investment has been forecast to be as follows. Sales volume we've been given from year 1 to year 4. Selling price we've been given year 1 to year 4. Variable cost year 1 to year 4. Fixed cost we've been given year 1 to year 4. Now, very important. This information must be what? Allowed for this information must be adjusted to allow for selling price inflation of 4% per year and variable cost inflation of what? 2.5%. So selling price is inflating at 4%, variable cost is inflating at 2.5%. Meaning the variable cost and then the selling price and the variable cost here are in what? Real terms. Can we agree on that? Meaning they are in real terms. Because it says must be adjusted. But look at the last statement. Fixed costs, which are wholly attributable to the project. Now listen to this one also. Wholly attributable. Assuming it was apportioned fixed cost, we won't bring it. We won't bring it. But that's why it says wholly attributable to the project. Meaning, if not for the project, we wouldn't have what? Incurred these fixed costs. So they are relevant for this project. Have already been adjusted for inflation. What does it mean? It means the fixed cost is already in nominal terms. Are you getting it? It has been adjusted for inflation. So there is no inflation on him. They are already in nominal terms. I love this question. Write that co pays profit after tax. So tax rate 30% per year. What? How is the tax paid? 1 year in arrears. Very important. So if 1 year in arrears and the project life is 4, meaning when we are doing our schedule, we will bring how many years? 5 years. Very important. Other information. Rider Co has a nominal before tax weighted average cost of 12% and a nominal after tax weighted average cost of what? 7%. Which of these two rates do we use? And why?
The nominal, because of the cash.
No, they are all nominal. Nominal before tax,
okay.
Nominal after tax. One is before tax, one is after tax. So which one do we use?
After tax.
After tax. Why?
Because
The cash flows are already included.
A liar has a tail.
because we do the capital allowance and then we depreciate.
Because, yes, but then the key thing is that because the cash flows are subject to tax. That is why we have to use the after-tax cost of capital. But assuming there was no tax, the cash flows are not subject to tax, then we have to use the before-tax cost of capital. We have to use the after-tax cost of capital because the cash flows are subject to what? Tax. If there was no tax in the cash flows, then we have to always use what? The before tax. Now, I also examine the money to four. Why did I say that? Because he could just give us the before tax rate. Now we're ending up. In that case, that means you will have to calculate what? The after tax rate. So how would you have calculated that? Simple. 12%, 1 minus the tax rate, 0.3. When you do this, I think you should get a 7% there. You will get a 7% there. Inti Sankawamai is 7% now. This is how we would have what? Calculated it ourselves. Okay. Calculate the net present value of the project and comment on whether this is financially acceptable to Rider Co. Alright. So what do we have to do? 1. The discount rate given to us, 7%, which is what we're going to use, is in nominal terms. But our selling price and the variable costs are in real terms. So we have to what? Inflate them. So let's do those workings first. As always. So workings, sales.
The investments are present. Sometimes the questions are done on Zoom. So it is question 1. If you start with it, it won't take time.
Yeah, so that is why, you see, naturally, most MA questions are actually time consuming. But the reason why, to some extent, you can be fast on investment appraisal is when you know what you are about. If you know what you are about, you can save time. Like what 14-mark question, you use 10 minutes. Why? Because now he understands it. So it's about when you understand well and you work with speed and accuracy, I think you should be able to go through. Just that MA, almost every question is sort of packed a little bit and will require some level of thinking. But once you have the understanding, you should be able to work with the time. Sales. Let's bring our year. 1, 2, 3, 4. Help me out. Selling price per unit given. No, that is the units. Selling price per unit. 25, 24, 23, 23. So this is the selling price per unit. But we got to inflate it. So what is the inflation rate? 4%. So when we are inflating, so inflated selling price per unit. So we apply the Fisher formula. 1 plus 0.04 exponent 1. What do we have? Times, did you multiply by this?
Okay. Times
26.
26.
I didn't know you are 24.
I didn't multiply by the 25.
Okay, so but when you multiply now you get 26.
Yes.
Okay. Year 2. The same thing by exponent 2, you multiply by 24. Okay? So 1.04 exponent 2 times 24.
25.95.
No, don't approximate here.
Okay.
Leave it in 2 decimal place and then do any approximation in the final answer rather. This, the same thing, 1.04 exponent 3 by 23. Now, don't be tempted that, we're 23, we're 23. It's remember they say Figambra, we're Diego. So 1.04 exponent 4 times 23.
26.991. 90.
90. But it's 90 what?
906.
906. Then we can bring in 91. Okay. So this is the inflated selling price. Now we can bring the sales volume in units. How much do we have?
50,000.
So 50,000,
95,000.
95,000,
140,000.
140,000, 70,000. So let's multiply. We are multiplying the inflated selling price per unit by the units produced or by the sales volume. So 26 by 50. 1,300,000. We go. And then are you on punching leave or what?
No, I was writing.
2465250.
B, is that 2?
Yes.
2465
250.
250. Be like this?
Yes.
We go.
The last one is 188 3700.
Be like that?
3621800.
Okay. So that's the sales volume. That's the sales volume. Then we come to the second thing. Variable cost. We apply the same, madam.
The fourth one,
Hmm?
year 4, the unit is wrong.
The unit is wrong.
It's 75,000.
And I'm sure 70. Into book punching then 70 Anna.
It's
Sorry.
the window is 201.
201.
8250.
201 250. Sorry. Let's go. Variable cost per unit as given. 10, 11, 12, 12.50. Now, inflated variable cost. What is the inflation rate? 2.5. So we go, the same idea. So this time around 1.025 exponent 1 times 10. 10.25. The same thing exponent 2 times 11.
11.56.
The same thing exponent 3 by 12.
12.3.
The same thing exponent 4 by 12.5. 13.7 what?
7.9, but the other one is more than.
Okay, so 13.8. Sales volume. Same here, right? 50,000, 95,000, 140,000, and then 75,000. We go for it. What we got?
The last
1 0 1 2 5 and
First one, 5, 1, 2, 5, 0, 0.
you like this?
Yes.
1806. Third one. 1,000.
1098.
1098 200. Okay. So these workings are cheap.
The first one, the zeros are 2.
Only 2.
Yes.
So 5 million. Okay, so it's not up to 5 million.
Yes, no.
So 512,500. Okay. So that's the first two workers. Usually, inflation stuff, you are not supposed to struggle with it. It's simple. Now let's come to my favorite zone, capital allowance. Working allowance. According here, working allowance. Me here working allowance. Mama be working allowance. Edwina,
Yeah.
I need working allowance.
Is it working allowance?
I'm writing working allowance on the board, so it means I need.
Work on it for you.
You work on it, Mate. So cost, depreciation, and then capital allowance. Now follow me carefully here, please. When we finish, right. The depreciation is what has been given to us, the 25%. Even though he says capital allowance, that will be the depreciation. Then the capital allowance is always what? The tax rate, which is 30%. So let's go for it. Year 1, what is the cost of the machine? 1,005. Because we're working in 3 zeros up. So 1,500, can I go please? 25%. 375. 30% of 375.
112.5.
So we can say 113. Okay? Because we work into the nearest thousand. Even all these figures, when we are putting them on the schedule, we are going to approximate and work to the nearest thousand, okay? To avoid those points in the tree. Year 2, reducing balance. Even
1125.
1125. 25% of that.
281. Okay, 281.
281. 90% of 281.
84.
84. Year 3.
So Shiva, when you do this in the example, it will be multiplied.
Yeah, it's part of your workings. You'll get marks for it.
That one too, I think I have to work on that.
The
I've
inflation.
been doing it like, no, I don't like, I don't work.
You don't do the workings. So how do you?
I don't work to the nearest. I write the whole figure there.
In the schedule, about that, it will worry you. That's why in the schedule we will approximate all these guys to the nearest thousand. Are you getting it? So that those coins they go training now. This one like this, we ignore the 200 and take what? 1098. This one we will take the 5 to 3 and make this one 1013. This one we will ignore the 250. This one the 8 we will take it to 2. This one we will ignore the 250. That thing. So that on the schedule we are working to the nearest thousand. Otherwise you'll be getting some figures at the back and it will take you time.
Yes.
It will take you time. So you just tell the examiner that all workings are in what? Thousand. Workings 3, reducing balance.
Eight four four.
844. 25% of that.
211.
30% of that.
63.
63. Now watch what happens in the final year. In the final year, can I have the reducing balance figure?
633.
633. Now this is the net book value of the assets in the 4th year. I said in the 4th year, don't charge depreciation. Ask what happened in the investment. We are told that the scrap value was what? 100,000. Into your 100,000 every move. That means even though the asset has a book value of 633, we will sell it for how much? Only 100. So what's the difference? 533. On this 533, we do straight 30% of that. That is a capital allowance we claim in the final year. 160. There you go. There you go. So that's what we mean by that. That's what we mean by that. So,
This one. Okay. There is one you have to guess.
yeah, when assuming it was sold for 1,000, meaning 1 million, because your net book value is 633. So this time around you will make a profit. So because of that you will pay tax. So in that case it will be in brackets. But this time you will make a loss.
Yeah, listen, salvage, is it salvage value?
Yes, salvage value or scrap value.
Okay.
Yes.
Assuming it was 1,000, so we find the difference.
Of whatever. 33.
1,000 minus 633.
Yeah.
That would be 367.
367. So you are making what was it? Way as to change way. It is in brackets. Now after 30% on this, so that that figure you get will be in brackets.
Like 110.
110. So that will be an outflow.
Okay. Okay.
But in this case, we are making a loss. So it will be an inflow for us. We will still claim this tax allowance.
Then assuming there was no
Scrap value, then we will do 30% straight on this figure.
Okay.
So in the final year, we don't calculate the depreciation. Now, let's put the pieces together in the NPV schedule on that last slide. Then my secretaries can do their job. Now remember that tax is paid in arrears. So investment appraisal or investment schedule. Okay. So here, even though it is 4, we are going to do 5. 1, 2, 3, 4, 5. And we are working to the nearest 1,000. We go. Sales. What do we have? Workings 1. So 1,300. Year 2. 2465. we will ignore this because yen to me running it up. But year 3, 3622 because the 8 will be run. Year 4, 2018. Now I didn't bring year 0. Okay, you know we can do it at the last end, right? So no P. Variable cost. Workings 2, we go. 513 and then 1098 1806 okay. Then what else? Fixed cost. There was fixed cost in the question. But we have to get contribution, so give me contribution. We go quickly. 787. Year 2. 1447. 1816. 1005. Okay. Then we now bring the fixed cost, which was given in the question, because
contribution, I'm getting a different figure.
Which one?
Yeah, 2465 less 1098. I'm getting 1367.
Edwina.
I did it 1018.
10. You are getting what?
1367.
Okay.
You are doing right.
First cost, it was given, so give it to me in the question like that.
105.
105.
115.
115.
125.
125.
125.
125. So let's get the profit. Taxable cash flows. 682. 1252. 1691. 888. 880, right?
Yeah.
Then what do we bring? Tax. What's the tax rate?
30%.
30%. So go for it now. Remember 1 year in arrears. So year 1 tax will go to 2, 2 will go to 3, 3 will go to 4, 4 will go to 5. Let's go.
245. 205, sir.
205. 30% on this.
376.
376. 30% on this.
503. No, 507.
Then 30% on this.
264.
264. Now saliva alone doesn't work. So we bring his brother. That's working 3, I guess. Is it 3? Yeah. Capital allowance. And moves in that order. And you know, this is where you got it wrong. 113, 84, 63, and what? 60. So, 160. And Japan. So what we were saying, assuming like we had a profit, then the last one will be in brackets. Be in that bracket. Any other item we are supposed to bring? Scrap value. Make sure you don't forget. How much was it? 100. We bring it to the
After
4.
allowance to 1 year in arrears.
Yes, because it goes with the tax. So the way we pay tax, that's the way we claim capital allowance.
You have this question.
Yeah.
Assuming there was working capital,
Yeah.
they said working capital is that would be
And working capital, maybe we can inject something. Maybe let me give an illustration and use it here. After we finish the work. Okay, I'll give an illustration and then use it here. If working capital was there, we would have bought it, but you would have to do a workings for it first. How do we do the workings? Let's finish with this because there is no working capital, then I deal with that for you. It's very important. Hey, are we done with everything in the question? Did we touch on everything? I guess so. So please give me net cash flows now. I think this is still 682. Let's go. One one six zero.
112.
Then we bring the discount factor. Remember, we are using the after-tax nominal rate, which is what? 7%. Who is reading? Tell your discount table.
See, people, there was a time the discount factor they used. You couldn't have found it on the top, so
you have to calculate.
Hey.
I saw it.
I said that thing calculation is not anything. It's just 1 over